They were trying to plant one idea in your head. You can get out of silver, so don't even get in. And if that idea sticks, it protects the exact people who've been leaning on the paper market for years. Here's the reality nobody wants to say out loud. Silver didn't just wander into triple digits. It kicked the door down. And when that happens, the most dangerous thing isn't volatility. It is the stories people tell to make you panic sell, right into someone else's buy order. The viral claim is everywhere. A man posts that he's sitting on a massive pile of silver bars, and when he tried to sell, nobody wanted it. Refineries won't touch it. Dealers lowballing way under spot. Banks looking at him like he's doing something illegal. The punchline, owning something and exiting something are different skills. That story went viral for one reason. It taps into a fear every investor knows. You buy something real, and the internet tells you, congrats, you bought a cage. But zoom out. That narrative has the DNA of every panic story. A complicated, situational problem becomes a blanket warning designed to scare the largest number of people. This pattern repeats across markets. People buy thinly traded stocks and are shocked they can dump huge positions without crushing the price. Collectibles? Value and buyers don't always show up simultaneously. That doesn't make the asset worthless. It means liquidity has a cost, and that cost spikes when urgency enters the picture. Silver is no different. There's the retail market, built on recognizable products with established two-way pricing. There's the wholesale market, where size matters, verification matters, timelines are negotiated. And there's the industrial pipeline, where buyers don't care about your Instagram photo of a stack. They care about purity, specifications, delivery windows, and uninterrupted supply. When someone says refineries won't touch it, the real questions are, which refinery, what product, what paperwork? Refineries exist to process metal. They avoid uncertainty. A pile of bars with unclear hallmarks or no traceable chain of custody gets delayed. Assays and verification take time. That's not a rejection of silver, it's a rejection of unknown risk. Dealers act the same way. A low quote isn't personal. It's pricing in overhead, hedging costs, fraud risk, and the fact that in fast markets, they can lose money between buying from you and replacing inventory. Calm markets make the spread invisible. Fast markets widen it, and suddenly everyone acts shocked. The practical truth, if you hold physical metal, you should already know where you would sell it. Not because you plan to dump it tomorrow, but because having a plan keeps you calm when chaos hits. Volume is the enemy of convenience. 10,000 ounces sold in one day. You call ahead, get quotes, understand limits, split the sale, compare local and national buyers, factor shipping, insurance, and timing. Sometimes the smartest move is not selling at all. Often, the need for liquidity is the real problem, not the metal. Once you understand the mechanics, the next observation hits. Selling pipelines are busy, yet the screen price keeps rising. Someone is absorbing that metal. That's when the story morphs from social media rumor into macro event. 3 things need to be separated. Can you sell silver at all? 2, can you sell instantly at the exact paper quote? 3, can you unload a massive position at once without planning? These are not the same. Conflating them is how the loudest voice manipulates the narrative. Yes, silver is selling. Buying activity is so strong that major dealers post active buyback quotes and seek inventory. But selling depends on what you hold, how much, and who you're selling to. Unfamiliar bars, no paperwork, and a demand for instant liquidation? Spreads widen. That's logistics, not conspiracy. Banks looked at the viral poster weirdly. No surprise, banks aren't in retail metal. That's like trying to sell groceries at a car dealership. Liquidity is a spectrum. Rare, damaged, or unusual products get punished. Giant bars may require assays. Massive positions may exceed local cash limits. Notice, the viral post said, nobody will touch it, not, it took time to find buyers. It's fear marketing. Meanwhile, dealers' buyback pages were active, quotes live, inventory moving, competitive prices on common products. Translation, the pipes are busy, not broken. Why push the "you're trapped" narrative? To convince people physical metal is dead, driving them toward assets that are easier to control, fee, or tokenize. The pivot from silver is hard to sell to this other asset is liquid 24/7 is the tell. Silver didn't hit triple digits because retail forgot how to check a buyback page. It hit triple digits because the underlying market tightened and the paper game started losing its grip. The signs are clear. Screen prices diverge from real-world transaction prices. Premiums balloon, delivery times stretch, specific products vanish. Paper prices swing while physical demand remains stubborn. That's not normal. It's a market under stress. This is not a call to dump savings into silver, sell your house, or go all in. It's a reminder that if you hold silver for structural reasons, the noise matters less than the setup. Over the last month, silver has snapped. Gold has surged past record levels. When both metals move together like this, it's rarely about retail speculation. It's about confidence, and confidence is scarce. Claims of massive selling and big players exiting don't match the price action. Dips are absorbed. Marginal buyers are not panicked social media sellers. They're industrial users. Manufacturing schedules, utilities, grid projects, and the energy transition consume silver relentlessly. Structural deficits have persisted for years. Stacked deficits pull nearly 900 million ounces from above-ground stockpiles. Solar demand alone can absorb over 120 million ounces. EV production, another 70 million, plus data centers, defense, medical, and infrastructure. A market that looks fine can shift suddenly. Tightness shows itself in delays, premium spikes, and sudden price gaps. Paper price is a reference. Real clearing price reflects what it takes to move, verify, and deliver metal. When the gap widens, repricing can accelerate. Confidence in paper slips, and people don't ease out. They stampede. The possibility of extreme moves isn't hype, it's structural math. Gold's record levels, shifts in gold to silver ratios, bond market stress, negative real yields, and expanding monetary claims all create pathways for violent repricing. M2 measures claims on real goods and labor. When claims grow faster than reality, purchasing power dilutes. Dilution doesn't hit evenly or on a schedule. People react. They chase momentum, flee risk, regret hesitation. Tight markets can spike vertically. Most silver comes as a byproduct. Base metal operations supply over half of global output. Primary silver mines are smaller. Recycling isn't instant. Supply feels frozen. When demand surges, price becomes the rationing tool, and it moves fast. Numbers like 300 aren't impossible. Even moves to 150 or 200 would rewrite balance sheets, portfolios, and politics. Policymakers pay attention. When the public shifts to assets that cannot be printed, control becomes the next act. Reality check on selling fear. Widely recognized bullion has a market, even during chaos. Huge bars require verification. That's normal, not a scam. Exit planning is essential, just like selling a property. Markets have rules, and understanding them keeps you steady. If you're holding a massive position, plan your exits like you would when selling a house. You don't just wake up and dump it all in a day expecting a perfect price. That's not silver's fault. That's how markets work. The real question is this: do you hold silver as insurance, or are you trying to trade it like a tech stock? The answer changes everything about how you interpret the rumors. Now, let's step into a scenario most people face once the dots start connecting. What if your retirement account is full of assets that depend on stability? What if you want some exposure to something tangible? Take an example. Someone has $50,000 in a retirement account looking at debt risk, interest rate risk, and currency exposure, and wants to reduce vulnerability. The biggest mistake is emotional timing. Dumping it all into one asset on one day sets you up for regret. Markets are designed to shake you out. A 10% drop after entry will feel catastrophic, even if your long-term thesis is intact. The safer approach is process over prediction. Decide what percentage belongs in hard assets. Decide on storage. Decide how it could be exited if needed. Then execute over time, so your emotional state isn't anchored to one price point. Custodial rules, tax implications, and storage requirements matter. This isn't buying a shiny thing. It's building a framework. Even when done right, expect volatility. Big volatility. Markets don't move in straight lines. They lurch, surge, dip, and run again. Experienced participants focus on the direction of underlying forces, not each close. And those forces explain why the rumor crowd goes quiet. If silver is everywhere, and everyone is supposedly selling, why are mints and manufacturers reporting tightness? Why are delivery times stretching in bursts? Why do regional premiums appear that shouldn't exist in a glut? Why are certain bar sizes suddenly scarce? That's not how oversupply behaves. Here's the next cliffhanger. The real question isn't whether you can sell. It's whether institutions can source enough metal at the paper quote. If they can't, repricing isn't optional. Recent market chatter suggests at least one major bank is reducing a historically large paper short position, while physical accumulation rises. The chatter may be exaggerated, but even the possibility matters. The paper market only functions as long as participants believe positions can roll or settle without friction. Once confidence falters, it behaves like a crowded theater with one exit. Another signal: parts of the Asian banking system have adjusted collateral frameworks, giving silver more weight relative to gold for certain lending. That indicates silver isn't just an industrial input. It's increasingly treated as monetary collateral. Not the world most imagine, and not the world the viral fear stories want you to believe. Central bank language can be translated plainly. Keeping reserves ample means ensuring liquidity. Adjusting balance sheet maturity manages interest rate exposure and stress. Adding reserves admits tightening has limits. That matters because metals react to liquidity and real rates. Forced easing weakens the measuring stick again. Zooming out, confidence is fraying. Commercial real estate stress is back. Delinquencies on securitized loans hover above 7%, with some office segments pressing toward double digits. Banks, pensions, and local tax bases are exposed. Households are stretched, with winter heating costs near $1,000 for many. Power demand isn't just organic growth. It's rising from data centers, electrification, and grid upgrades, metals, intensive pressures. Currency stress adds volatility. The yen swings violently, sparking speculation about intervention. Even a hint moves billions in seconds. This isn't just Forex, it's confidence in motion. Anchors matter. Dollars, gold, silver, crypto. Liquidity isn't safety. Crypto can sell instantly, but it carries exchange risk, regulatory risk, custody risk, and correlation spikes during panics. Huge numbers don't remove risk. They attract attention. Not every warning about silver liquidity is part of a scheme. Sometimes it's a personal experience misrepresented. Sometimes it's fear. The mistake is treating one anecdote as a universal rule. The universal rule is simple. Plan your exit before you need it. Silver is doing two jobs at once. A monetary metal reacting to trust, an industrial metal reacting to supply chains. When both ignite, moves become explosive. The system is flashing signals: debt pressure, rate sensitivity, fragile commercial real estate, currency volatility, household strain. None guarantees a straight line rise, but they explain why rumors push people out of physical metal. Because if the public decides physical matters, paper control becomes harder. That's the real fight. Here's the takeaway. Don't let viral stories bully you. Know your exit routes, local buyers, online buybacks, peer-to-peer options. Add metal deliberately, staggered, diversified, with liquidity intact. Watch signals that can't be faked. Inventory tightness, delivery delays, persistent premiums, price behavior on dips. Nobody can promise where silver trades next week. Nobody can promise there won't be sharp pullbacks. But the idea that you're trapped in silver is a story, and stories are tools. The people who win in markets are those who distinguish a tool from the truth.